Hi, everybody. It's Dave Fry, ETF Digest, and we are going to be doing a podcast with Steve Hammer today. Steve is an authority on the enigmatic HFTs, high-frequency trading. As you are well aware, these have been one of the most enigmatic, much discussed in the news, and a lot of people just don't know what they're all about. But Steve has started his website, HFT Alert, and Steve started in the industry in 1980 as a stockbroker in Denver. In 1990, he started an investment advisory firm, and in 94 founded Cyberfund LLC, which invested in public and private technology companies. He retired from the investment management industry in 2003. But since 1998, he has designed a variety of market analytical tools that he continues to use. Many of these programs have been advanced tape reading tools. After the flash crash in 2010, he became interested in algorithmic trading, especially finding ways to identify them. Working with Nanex NLC, they created HFT Alert. And Steve, welcome.
Well, thank you, Dave. Nanex is a company located in Chicago that has been providing market data for a variety of participants, and they have probably more experience than anyone in terms of examining the tape and looking at quote feeds. And after the flash crash occurred, they provided a great deal of research into the causes of it and some of the problems within the HFT and algorithmic trading area. So the technology behind HFT Alert, the software that we are marketing, was developed by Nanex, and HFT Alert is the website where that software is available.
Why don't you explain more about HFT Basic? This is really what we want to talk about in basically two parts of this interview. We'd like to first have Steve describe HFT trading algorithms and all these strange things that we read about all the time. Then we'll move on to his website and how you might benefit by using it. Try and give us an overview of HFT trading and algorithms.
Sure, Dave. My pleasure. The origins of HFT systems really start in 2007. Prior to 2007, if you were listed on an exchange, your stock typically traded on that exchange. So if you were listed on the New York Stock Exchange, most of the volume would occur on the New York Stock Exchange. But as technology and regional exchanges grew, the regulators saw and the exchanges saw that there were some rather large pricing discrepancies between the exchanges, so that individual investors and institutions, when they bought and sold, may not have always gotten the best bid or the best offer. So the exchanges envisioned a system wherein the best bid or offer could be automatically routed to whatever order was placed at the time. So over a period of time, the exchanges and the SEC created Reg NMS, which stands for National Market System, which allowed any stock on any exchange to be traded on any exchange, and an order would be routed to that best bid or that best offer. Now, in theory, Reg NMS is a great idea. It would guarantee to any investor at any time that they put in an order to buy something or an order to sell something, that that order, rather than being executed at one price or another price, would always be executed at the best bid or the best offer. And that was a great thing, and it would have tremendous benefits for our capital market. But the regulators forgot one thing. They forgot about the speed of light, that it takes a period of time for a quote after it leaves the exchange to be disseminated across the country. It takes about 100 milliseconds or so. And this latency, which is inherent in that system, is essentially the cause of some of the problem. An HFT system initially was envisioned as a market-making tool. Rather than having rooms full of individuals on telephones, they could use machines to automatically route those bids and offers and those orders to buy stock to a single place. So all HFTs are algorithmic trading systems, but not all algorithmic trading systems are HFTs. The distinction is that high-frequency systems, especially the market-making systems, are co-located at the exchange, and they get their feeds directly from the exchange. Now, the market data that you and I see comes from the exchange, goes to a third-party vendor that then processes that information, and then that information is disseminated out to you and me and institutions around the world. Well, by default, it's already a delayed feed relative to the high-frequency trading systems that are co-located at the exchange. And these high-frequency systems rely that they get this pricing information a split second before anybody else does. So they have an inherent advantage over everyone. In the past, in market-making activities, for example, back in 1980 when I first got into the business, I worked for a company in Denver, an OTC trading desk, and we made markets in about a dozen different stocks. And from time to time, as a market maker, I would see both sides of the trade. Someone would call me up, say I've got 10,000 to go at this price. I'd work that order, and if I could buy stock at the bid and sell stock at the offer or vice versa, I would make the spread. And back then, the spreads were relatively large, certainly compared with today. So the exchanges and the SEC believed that if they could increase the time that these trades were executed, that these spreads would narrow and everyone would benefit from that. But what I see as the main distinction between market-making activities in the past and market-making activities today is that the HFT systems that are providing this market-making function are seeing these quotes long before, from a computer's time frame, long before you and I see them, and they are in effect front-running and executing these trades when there's a profit. So while I don't know for sure, because I've never had the opportunity to interview, as have many financial reporters not had the opportunity to interview the people that run these systems, it would seem to me that if they're seeing the quotes first, then the types of risks that I and other market makers were taking back in the 80s and 90s are just not the same as they are now. In fact, I think many of these systems essentially front-run these tapes and provide this liquidity essentially zero risk to themselves. And I think this is one of the reasons why you've seen such a huge explosion in HFT trading systems in the United States, and this is spreading in other countries as well.
When did this first get going?
In February of 2007 is when Reg NMS put into place. And if you were to look at a monthly volume chart of the market, look at the Dow, for example, or the S&P on a monthly basis, and look at the volume, you'll see that the volume increase is literally exponential from 2007 to today. And that's not because there are more people in the market, that there's more institutions, that people across the United States are more involved in buying and selling stocks. It's because the machines are out there pushing stocks around at such great speed that these volumes are just soaring. Not so much, again, because there's more people involved, but there's just simply more machines pushing stock prices and volumes back and forth.
When you said they were co-located, as I understand it, there is a whole floor at the exchange above the trading floor, and there's a whole floor dedicated to these servers for HFT traders. Is that right?
Yes, it is. In fact, there's a very large building in New Jersey that's about the size of 3 football fields. It's filled with literally thousands of computers. The feed is sent directly from the exchange directly into this building first, and there's so much competition, and because light has a time period that can travel through a fiber optic network, the exchanges, the NYSE, has had to put in place a system that guarantees that every computer that is in that building is getting the feed at the same time. So the computers that are closer to the feed, I'm talking physical distance of the wire, they've had to add latency so that all those machines essentially are getting the quotes at the same time. So they're the only level playing field that I'm aware of is in that building.
I also understand that a lot of trades that take place, there are rebates involved to HFT traders, even if they are making trades that make them no money, but they make money back from the exchange for the volume and the activity that's going on. Is that right?
Yes, that's right, Dave. There are rebate traders, and the exchanges and the ECNs have provided a rebate to people providing liquidity and a cost for taking liquidity. If you provide liquidity, in other words, you put in a limit to buy stock or you put in a limit to sell stock, you're given 20 cents per 100 shares for providing that liquidity. If you take liquidity from the market, in other words, you put in a limit order, put in a market order, or you sell at someone's limit or purchase at a limit, you're taking liquidity from the market. That costs 30 cents per 100 share. The exchanges make the dime. There are some systems which are called liquidity trading system, where let's say a stock is bid 20 cents and offered at $20.03, and offered it at $20.03. If I have a liquidity trading system and someone's offering stock at 3 cents. Well, if I can go in and buy the stock at 20.01 and sell it to that guy at 20.03, then I can make that 20 cents. Or if I can buy and sell off of my limits at zero profit, in other words, I buy it at 20.01, I immediately sell it at 20.01, I can make that 20 cents on 100 shares. And some systems are designed solely just to do this. Some of the market making function people have complained about this because it enables a system to get in between their spread, take or provide liquidity from the market, and make that 20 cents.
When you're talking about this particular trade, for example, this is just on 100 shares, but they're dealing in thousands of shares and millions of shares in terms of total activity during any particular day.
And they can do it over and over and over again. So the amount of stock, even if it's only 100 shares, these systems can just click away on thousands of different stocks all day long, all week long. And essentially, if they can make these trades, the trades will go. The trades won't go unless they can literally simultaneously print them. And they just print money from the exchanges.
Well, this is really quite amazing to know. HFT Alert exists to assist investors in terms of following these and acting upon them if, in fact, they were traders, for example. So let's take a look at some of the packages now that you are offering to the public, to the subscribers, and how they may take advantage of them. You have 3 separate packages, I understand. The basic, which costs $25 a month, is at $50 a month, and then there's the professional at $100 a month. Let's go over how you want to display this and how a day trader, other than investing warriors of some kind, how they might benefit or take advantage of these programs that you offer in conjunction with what they're doing in terms of trading.
Okay, Dave, we have 3 packages, HFT Alert Lite, we have HFT Alert, and HFT Alert Pro. And something that your users might want to remember is even though all HFTs are algorithmic systems, not all algorithmic systems are HFTs. And I believe the vast majority of algorithmic trading going on out there are on non-collocated systems all across the United States. And these systems can do a variety of different types of things, from trading ranges to trading news events, various types of strategies. There's arbitrage between stocks and options. So an algorithmic system, even though some HFT systems might be the evil beasts of the market, most algorithmic trading systems, in my opinion, are not. And they simply replace the types of systems that individuals would do by themselves. They're done with computers. And that's what HFT Alert is designed to monitor, is not only HFT systems, which show up in various ways, but the other types of algorithmic systems that come into the market. So our main product is HFT Alert, which is the one that you see on the screen. And what it does is it shows these graphs here on this right side show overall levels of algorithmic activity across the entire market. And you can look at it in a variety of different ways. This upper graphic right here is the main graphic that I like to watch during the day. It monitors 16 different exchanges and will display the various types of activity on each exchange. But what I like to do is watch the total across all exchanges. And that shows you at any one time the amount of activity going on in the market. So this spike right here that we see is about a 50-share program that went off. We detected had 50 stocks in it.
But that window is for the algos, is that right?
Yes, we have an algorithmic detection model built into the program that detects the number of stocks with HFT or algorithmic sequences in them. This could be a fluttering algorithm, a cycle repeater algorithm, anything that has a repetitious pattern or even over small bursts of time. So we can see as we're moving across here that there are a variety of programs hitting the 20 to 40 levels of small background level. And here we can see that we've throughout the day, this is over the last hour, here's a spike up here to over 150 stocks. And what I've noticed over the 7 or 8 months I've been using the software, that if you watch a 1-minute SPY bar, for example, let me bring that up, that most of the time when you see a large expansion bar, like this one right here, that these large expansion bars, an expansion bar is a 1-minute time bar that has a greater range than the normal bar, usually by 2 or 3 times. And almost 90% of the time, whenever you see a large spike over 100 stocks on HFT Alert, you're going to see a large expansion bar on the price bars. And as you go through the day, if you're a day trader and you watch the various levels that these come in, you're able to to see and deduce what some of these programs are doing, whether they're buying the lows, whether they're selling the highs, whether they're buying through the highs or selling through the lows.
Just let me add here, what you're looking at on these graphs are by the second. Is that correct?
That's correct. The resolution is shown every second. These tables over here will show the various types of quote rates that come in, and we should talk about quote rates because that's a very important aspect of what's going on in the market. In fact, let's segue to that right now. Quote rates are what high-frequency and algorithmic trading systems use to influence or manipulate the price of a stock. When you and I as individuals put in an order to buy or sell a stock, we'll turn on our trading system or use our web browser to enter an order at a brokerage firm, and we'll say, buy 1,000 SPY at 135, and we'll put in a limit, for example, and then we'll turn off our program and we'll wait for that to be executed. Well, when an algorithmic or HFT system, especially an HFT system, one that's co-located, they put in up to 20,000 quotes in a single second. And a quote is an order. And so these systems, if you watch the quote rates, you'll see how active they are. And quote rates are potentially a very dangerous thing. Since 2007, and I can put up another graphic here, what this graph shows is the growth in quote traffic. These are 2 millisecond resolution over a 30-minute time period. So the number of quotes per millisecond are shown up here on this right column. So here's 1.1 million and here's 300,000. The blue lines represent dates. So as you go from blue to red, you're going from 10/13/2010 up to 7/14/2011. And these blank spaces in between these graphs represent the day that the CQS system's capacity was increased. So with the exception of this one period here, pretty much every time they increased the capacity, the instant they increased it, the system was already at capacity. So we can see here, these red, this is here in July, in October of this year. You can see we're already up to 1.1 million quotes per second. Now, as technology increases, these speeds increase. And as these speeds increase, the system gets saturated even faster. And the issue with these quotes and quote rates is as follows. What is the point of putting in 20,000 quote changes in a second when any one of those quotes hasn't had enough time to leave the queue, be disseminated throughout the market, and let you or I have a chance to operate on them, to take advantage of that offer or that bid on a stock? Well, the simple fact of the matter is, if we were floor traders, and every time we offered stock, as soon as someone wanted to buy it, we instantly pulled it back, and our quotes were never any good, and we would have been not only kicked off the exchange, but we'd be violating a law. It's illegal to put in a phony bid or a phony offer. Your offer or your bid has to be good for something. But yet that's exactly what many of these HFT systems are doing. They're putting out so many quotes that no one has an opportunity to operate on them. So in effect, what they're doing is creating financial spam, and we track that. And what that spam does is it increases the latency in the system. It makes that delay even longer, which gives an advantage to HFT systems more than what they just originally enjoy. So high quote rates, what we follow here, this is HFT Alert we're looking at. This first column monitors stocks with high quote counts over 1,000 quotes per second. So here we can see we've highlighted IWM, had 3,503 quote changes, 190 trades, and 1,400 best bidder offer changes in this single second. I happen to have a list put into HFT Alert that shows that we have just ETFs on it. So when we look down this list, and we'll see if we can find stock with zero, this quote right here, TBT, 1,184 quote changes, 222 best bidder offer changes, and no trades. This was an algorithm fluttering this particular ETF at that point in time at 10:58:17. So when you're using HFT Alert and running stocks, and I'll turn off our symbol filters here for a minute, we'll see a much greater increase in stocks on this list, and we'll go find one that's undergoing some fluttering. Here we can see we just had a very large burst. Here's over 100 stocks, and we'll bring up and you can see that was a down bar. This down bar right here, this expansion bar, and this next one was caused by this program right here. Here's another one. Bring this back up and see we're getting a very large expansion bar. Prices dropping quickly. And that's a result of these spikes right here. This one's over 100. This one looks like 125. And you can see the quote rates increasing over here. So if you knew that these machines were pushing the price in one direction or another, it'll probably stop right here at this low. It's probably a range trading algo. It'll either stop right here or it'll stop right here at this level, 128.30. As you watch these, you can see whether the machines are pushing the stock prices or whether they're not. And what I found over using the stock, this system for a while, is that when you see these large bursts come in and you don't see any change in price, then that's probably an algorithmic system, not an HFT system, and it might be a portfolio manager, an order entry system that has gone out and purchased or sold a large number of shares at that particular point in time.
Let's say, for example, I'm a trader and I'm using this. How would I go about using that information for my benefit as a subscriber to HFT Alert?
Program trades occur over very brief periods of time, and they typically don't follow through. You won't see them continuously hit 100 stocks over and over and over again. They come in bursts. So if you're a trader and you're watching this and you see a burst come in and you've simply gone from the prior high, which in this case was 128.70, back down to a prior low, you can expect that that's where the stock market will stop. That's where SPY will hold for a period of time unless you see follow-through bursts. Many times traders will see a big move in the stock price and they'll be attracted by the quick move, and they may jump in or jump out just because of the movement in price. Well, if you knew that a machine was pushing it, if you knew that a program was coming in and could see when it came in and whether it was buying or whether it was selling at that point in time on the basis of where the bar was going, then you wouldn't necessarily bail. If you were a smart trader, you'd be looking to possibly get back in at that position or establish a long position if you saw no additional spikes come in and breadth remained the same and your other indicators and the various charting and analytical programs that you're using showed that there wasn't a trend change at that point, that it was just a machine pushing it, then that's very valuable information for you. HFT Alert's really designed to be used alongside the analytical and market charting programs that most traders utilize. It's not meant to be used by itself. The other thing that the program shows, HFT Alert shows, is this column right here shows the high algo sequence counts. We have a number of detection algorithms that run on this list and will identify the type of manipulation or the influencing that is going on. In this case, we're seeing here FOR. The BS here stands for a bid size cycle repeater or flutterer. BP here, which stand for bid price. AS and AP stand for ask price and ask sizes. And by using HFT Alert and loading in your symbol lists, if you were buying or selling a stock and saw that one of your stocks was showing up on this list, then you would know that an algorithm had targeted your stock and that you need to be careful about whether you're putting in a market order or a limit order. Here we're seeing another expansion bar, another group of smaller spikes. The thing that I've noticed as HFTs and algorithmic systems have started up is these quote rates. As you watch those, especially when they occur on secondary exchanges like BATS or the Pacific Exchange or the Philly Exchange, that many times those types of quotes are in to influence the price of a stock on its bid or its offer. How many times have you gone onto your trading screen and brought up Google or another stock and you've looked at it and the quotes are just moving around so quick you have no idea where to stick your limit in, or even if you could put in a limit, whether it would get executed. So many times the smaller investors are forced to stick in market orders. Well, putting in a market order at a time when a stock is being fluttered or there's a cycle repeater running on the stock is a license to steal for these systems. And if they can cross the market and lock the spread for a fraction of a second, then they can go through and take out any limit order above or below that price. And that results in a very short-term but very brief, wide swing in the price of that stock. A couple of weeks ago, I was monitoring a couple of different stocks that were showing up on the screen, and we were charting out the bids and the offers as they were occurring. And then the trades would come in, and you'd see up to a 5 or 6% spread in some of the trades during that single second period of time, even though when you were looking at the quote, you saw no change whatsoever. The spread stayed the same. The stock didn't do anything. Yet all of a sudden, here are all these trades coming through in various quantities at various prices that were outside of the spread at that point in time. And that's some of the risks of trading with some of these systems running on a particular stock.
This package that we're looking at on the screen is just HFT Alert Basic.
This is HFT Alert. This is the full program.
How would somebody use this versus the other we were looking at?
They would use it exactly the same. They would watch, with one exception. There's only one list in HFT Alert Lite. It's really designed as a low-cost opportunity for someone to watch the program for a month, see how it works, see if it can add any value to their trading by seeing the times of the day when the spikes come in, and see the high quote count column. HFT Alert Lite does not have symbol lists, and it doesn't have some additional alarm systems that come with the standard package, which is HFT Alert, which you're looking at right now. The HFT Alert is $50 a month. That has all three lists, it has all three graphs, and it has a whole series of audio alerts that you can set up so that if you're running the program in the background, let's say you want to set up your symbol lists and only be alerted if you see a quote count on it over 2,000 quotes a second, it'll set off an alarm. Or if you only want to be told that when the spike comes in on the upper graph over some level that you can set anywhere from 0 to 1,000, it'll play an alarm. HFT Alert Pro is much, much more powerful than the other two programs and is designed for portfolio managers that need to follow a large number of stocks. Either on HFT Alert or HFT Alert Pro, the symbol lists are unlimited. You can put in as many symbols as you want. And what HFT Alert Pro does is monitor quote bursts, monitors specifically for quote fluttering, and monitors specifically for cycle repeaters. Cycle repeaters and quote fluttering are the types of algorithms that traders really need to know about most because they're going to have an immediate impact on the way that stock is being quoted and how it's being traded.
If I was a day trader as opposed to a portfolio manager and the mid-level program, not the light, but the mid-level program, I can create my own list of ETFs, for example. That's my bag, obviously. And just include those. The list is as I choose to make it. Then isolate and reduce the flow to just those. Is that right?
Yes, that is. This list eliminate button, which we have checked here, will only show the stocks in our list as they show up on HFT Alert. So you can either look at all your stocks individually, or you can have your stocks be highlighted amongst all the stocks that are detected by HFT Alert during the day.
What you would recommend to people, and we could go on for a long time, folks, but the recommendation would be to try it for a month if you're trading, as he has suggested. I think for us, for most of our followers, you would want to create a list of ETFs, whether they're leveraged or not, and see what kind of activity is going on, being able to place your orders in a better fashion once you see these spikes and what's going on, real trades versus not trades. And would you say that's a fair statement?
Yes, it is. The alert package is the package that we really recommend people to try if you don't trade every day. And I'll be frank, Dave, if you're not trading throughout the day, using HFT Alert's really not going to help you. It's really designed for someone who is an active trader that's trading the market every day, is making at least several trades throughout the day. The light package, if you're an ETF buyer or rather an ETF investor, you could try the light package at $25 the day that you're planning on going in and making your purchase. If you were to run HFT Alert Light while you were doing that and saw a big change in price and saw that it was being machine driven, might want to wait for a few minutes. Typically what I've seen, especially if news events come out, you'll get a big spike. Those spikes typically reverse themselves if they're machine driven. If they're not machine driven, what you'll see, and I'll show you here, is you'll see rather than just one big large spike, is you'll see these additional patterns show up where you have multiple spikes coming in this 40 to 50, 60 range. And those are representative not only of algorithmic trading systems, but individuals buying and selling the same security at the same time. So it will not only show algorithmic activity, but individual activity as well in the form of this background level.
Steve, I think, has done a pretty good job of telling us what HFTs are. If you go back to his website, some tutorial videos that further explain what he does. And Steve, I really appreciate you taking the time to help us demystify HFTs and HFT trading.
Well, thank you so much for the opportunity, Dave. I look forward to talking with you again and answering any of the questions that any of your subscribers might have.
Okay, Steve, thanks, and have a good day in Santa Barbara.
Off to the golf course.